Hey everyone, it's Imran from Options Insight. Happy Friday. This is your macro options spotlight. Okay, so stocks were way down after obviously Powell's hawkish comments after the FOMC press conference. So that was just kind of market was digesting that and felt pretty heavy still yesterday. But it was a relatively orderly sell-off. It wasn't like some big crash. It was just people just kind of realizing, okay, hope for this dovish pivot's kind of gone, and some longs getting out, and the market just staying relatively, in a negative sort of frame of mind. Now, if we look at what happened elsewhere, cable got absolutely hammered, 2% on the day. So another decent move there on something that's got an implied vol of 13. 2% daily move equates to 32 vol. Not bad if you're long gamma on that thing. Why did it come off so much? Because the Bank of England delivered their 75 basis point hike, but they tried to talk down terminal rates, basically saying that the market's got rates too high. Obviously, the economy is a lot weaker in the UK, and basically markets kind of took that to say, okay, the pound needs to come off sharpish. So we'll see what happens with non-farms and CPI next week. But if the dollar remains on the front foot here, cable is at risk of breaching that 110 level again. At which point, who knows how far this thing wants to go. But some people are calling parity on this thing. I'm not sure it happens particularly quickly, but yeah, I'm not stepping in the way of it. Bonds also remain heavy despite the yield curve inverting even further. So that 2s10s is about minus 50 right now, which is as far as it's been. And commodities are swinging around like crazy. We did see them down yesterday. They're ripping higher again today on the back of China potentially dropping some COVID restrictions for airlines and things like that. So these rumors about their policy pivot regarding COVID are kind of now starting to see some truth. And China's stocks are up about 5% as well. In pre-market. So before, well, not pre-market, obviously Asian markets have been open, but in terms of FXI, what we track, the US ETF, that is pre-market, but that's indicating up around 5%. So pretty punchy move there. Okay, vols softer with spot lower. So not a typical sort of move that we tend to see. So we have seen on the week, vol quite a bit lower in terms of stocks. But S&P down 2.3% on the week, with vol down 1 on the week. That's pretty unusual. So it really goes to show the street kind of getting caught long a bit of vol, it seems. They've got some inventory and there's no rush to buy vol right now. So, VIX performing pretty poorly there on the way down as well. Vols in China still relatively bid because this thing's moving around like an animal. Commodity vols have come down. We're seeing both oil and copper vols drifting there. Bond vol continuing to come down. That was down about 5 vols last week. It's down 2 vols this week. So pretty brutal in terms of what TLT vols are doing. And we're seeing the move index come down as well there. Carry wise, no major changes in carry. We're still seeing carry positive in gold. We're seeing carry positive in European stocks, and then also still in bonds. And like I said, those FX markets are still moving around pretty violently. So we're seeing negative carry across the board there. And then if we have a look at skew, I mean, we're seeing another day, another low in S&P skew, right? So you've got S&P skew on a 2 handle now, down another 70 basis points a day. It makes sense that skew was offered yesterday, because when you see a day like market down 1% and vol offered, skew is performing terribly in the US, right? It's in the S&P. So skew down in China as well, down in Europe as well. But I mean, these levels are getting pretty extreme now. I understand why they're there, but it's one of those things. It's a mean reverting type asset, usually vol, skew, these type of metrics. So I wouldn't be surprised to see some sort of bounce in skew at some point, but it just needs a bit of a catalyst. And right now it feels that if we're not going to get a horrible down day of like 3% plus, then these vols just aren't going to perform. So you kind of need less orderly sell-off and more violent sell-off to trigger some sort of bounce in vol and then some sort of bounce in skew. Remains to be seen. I suspect that's what's coming if we break lower below, say, 3,400. But on the way from here to 35, it could well remain orderly. And who knows how low this skew is going to go, because no one seems to want to buy it right now. Okay, that's the summary on vol for today. Okay, what else is everyone looking at today? Obviously, non-farm payrolls is the main event. It's going to show us, if the labor market is as strong as maybe that's being suggested by Jerome Powell in his press conference. post FOMC. The forecasts are for 195k jobs to be added. And if we look back, these are some charts from Jim Bianco, who you've got to follow if you don't already. He's basically making the point that Wall Street estimates on these payroll numbers have been pretty much undershooting all year. So 10 out of the last 12 months, these estimates have been beaten by the actual number. So if you're just going on pure sort of probabilities, whatever models these guys are using are undershooting. And if we look at initial jobless claims, which maybe tends to lead this stuff, initial jobless claims have been coming down since July. So there is a chance that we beat again on the jobs front. And if we do beat again, the market's probably quite fragile right now, and we may see yields go higher. We may see terminal rates continue to push higher as they have done over the last sort of 48 hours, and that may sink stocks further. Does that mean stocks are going to puke hard? Who knows? On the last non-farms, we did manage to sell off 3%. So we'll see. I do think the setup in the market, I do think the street is short Gamma. Clearly, they're not short Vega, so they're not reaching to buy a load of optionality, but the kind of erratic nature of spot prices shows you that maybe the Gamma position is not so well balanced. So we may still get some big moves on the day once we see that print. And that print's due in about 10 minutes. Okay. I do think CPI is going to have more impact next Thursday than today's non-farms, but we need to wait and see what happens. Okay, and then the last thing I want to wrap up with is VIX. So we mentioned VIX has kind of been struggling a bit. Since the S&P rolled over post FOMC, the VIX has actually traded down. There's not really typical price action. We can see the VIX curve here. We're seeing about 25 in the front end. That was my target for where I think it would find some support. We've kind of got there now, and maybe post non-farms, we might even kind of overshoot again a little bit more to the downside into the weekend. But with the likes of midterms, with the likes of CPI, and just the general macro backdrop, I do not think the VIX is heading to 20. I could be wrong, but that's just not what I think is happening. Now, the lack of responsiveness in the VIX to S&P moves to the downside is at an extreme, right? So with something we track called the 1 month VIX beta, we track the 1 month and the 3 month. And these are reaching pretty ridiculous levels, right? So we do a regression on the short-term horizon of how the VIX and the S&P are moving in relation to each other. And you can see that this regression has been flattening over the last few months. So that was 2 months ago was the white line. A month ago was the yellow line, and then the green is the last month. So you can see it just keeps flattening off. So it's showing that the VIX doesn't really care where the S&P goes. It's just kind of floating wherever we go. And that's also here from this orange line. This is our 1 month VIX beta, which is at an absolute extreme if we go back a couple of years. But even if we go back even further, it doesn't really ever tend to get this low. So it's quite unusual. And the reason why it's also unusual is because VIX is actually at 25. If VIX was at 12 and there was no VIX beta, you could understand it because it's just so low that it's kind of become agnostic to where spot goes, right? But when VIX is at 25, you would expect there's lots of room for vol to go down and there's lots of room for vol to go up. So you'd expect it to have some reactivity to S&P, but it doesn't really seem to have that right now. And partly that is explained by how they're crushing the skew and flattening the skew on S&P, which is basically saying that, the VIX is less dependent on the direction that the S&P goes, right? It's almost like it's becoming a more independent asset. And that's certainly what we're seeing in the metrics. Now, I don't believe that phenomenon to persist. So I think it's probably an opportunity to buy some tail risk given what's going on there. But you can't deny the data is showing you that the VIX is becoming less and less sensitive. All right, that's it for today's note. Have a good weekend. Be careful out there. These data points are moving the market wildly. We've got non-farms just about to hit. And I'll catch you guys next week. Thanks.